You can't talk about property without looking at what's happening in the lending space. So when I talk about lending, I'm talking about what the banks are willing to give you as a loan, what structures are changing, and there are a couple of really key updates when it comes to financing for property that is going to change the way the property landscape looks like in the next couple of years. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, if you're interested in property updates and what's happening in the next 12 to 24 months and how you can best prepare, I've actually got a free webinar I am running. It's live, it's with a Q&A as well, so you can ask me absolutely anything. It'll be the first link you see. It's a completely free webinar. So go ahead, click down below, register so you can join me on the 25th of November. If you're watching this after the 25th of November, we've already updated the links so you can still get access to the webinar. Now, why is it important that we understand finance when it comes to property? The 99% of people that are purchasing real estate today need finance from a bank to be able to go and do it. So when you see a slowdown in finance, you will often see a lag effect into the property market when it comes to property prices. The same thing happens on the other side. And there's plenty of examples of this, but let's go down to the nitty-gritty of the Royal Commission. For those that weren't around investing in property, or my channel definitely didn't exist, so if you weren't interested in that space, you have no idea what I'm talking about. But in 2016, Sydney hit the top of the market, everywhere was absolutely booming, interest rates were on their way down, nothing really to report on that front, but it was really around lending. What you had at that point was the complete opposite of what we had right now. If honestly we still had those times right now, I would be really concerned about a GFC-like event in Australia. So I'm actually so glad it played out back then. Now, I was still invested in the market and I saw my property prices across some of the properties I held go down slightly in those couple of years. And the reason why it was so important was APRA, that's the governing body for the banks, came out and said, look, we need responsible lending. People were honestly at that point going in 3%, 5% deposits, but also there was no open banking. So you could go out to one bank and literally do something here and then not tell the other bank and there was no way to find out. It was absolutely wild. And I know now in 2025 or 2026, you're thinking about it and going, how the F was that even allowed? Anyways, it was a pretty crazy time. You could get interest-only loans pretty easily. And in some cases, there was little to no buffers either. So if you don't know, when you're going out and getting a loan from a bank or a broker, so the way the bank is calculating your servicing ability and your borrowing power is by looking at the interest rate. So let's call it 5.5%. They're also then looking at a 3% buffer on top of that. So they're saying you're actually going to get assessed not at 5.5%, but at 8%. The other thing that they do is they often go out and have rental shading, which means if you're earning a certain income, they will go and shade 20 or 30% of that income that you generate. So if you generate, say, $30,000, they will say, okay, we're gonna only take 70% of that income towards your borrowing capacity, which is why it's crazy that in Australia, at a certain point, you could go out and buy property, and as long as it put money back into your pocket, because say you were earning a 6.5% yield, and then your actual costs were about 5%, you would be saying that I'm making more income, so disregard the debt, let's continue borrowing. So yes, I am glad things have changed since then. We did see prices actually move down post that as well. So why do I bring up that example? Well, there's a lot of things that are happening at the moment that might be sounding very familiar. And what we need to understand is how cause and effect actually works, which is why I give you some context as well. Now, separate to this, if you are interested in increasing your borrowing capacity, definitely go check out this video, bookmark it so you can watch it next. I go through some strategies that you can do even in today's market to increase your borrowing capacity to up to $250,000. Now, a lot of people covered this off. There were news articles everywhere and then it sort of died off. And so I wanted to go and deep dive into what this actually looked like. Macquarie Bank came out and said, we're not actually going out and lending to trusts anymore. So if you're new to the channel and you have no idea what I'm talking about, trust lending became so popular over the last couple of years because there was this unlimited borrowing capacity element to it. Now, I covered this off in a whiteboard video, so I explained it in detail so you're not getting confused in this video. If you're familiar with trust lending or not familiar with it, you still need to go check it out because I cover off a few things that most people don't. So what's happened is Macquarie Bank has come out and said, actually, we're going to put this to an end. If you want to borrow with us, you've got to basically buy under your personal name. Otherwise, we're not interested. If you're going out there and doing under a trust, we're not interested in giving you any more loans. Now, on the surface, people freaked out because they said, okay, well, if they don't lend to the trusts anymore, every other bank's going to follow. What does that actually mean? Well, the reality is that I think what's happened in the background is they took on way too much lending. Every broker absolutely loves dealing with Macquarie Bank because of their unbelievable SLAs when it comes to approvals and going out and getting a loan. So what they've probably done is grown their book significantly. And now to a point, they're like, actually, we don't want to take on that much risk. Let's slow things down. And they would have seen a lot of applications come through for residential borrowing in trusts. So they said, well, let's just stop that part. We still want the residential stuff, but we just don't want stuff in the trusts. So that's all that's really happened. Now, does that mean every other bank's going to follow? Well, nothing's really happened since then in terms of other banks wanting to do it. If you were going out to Macquarie Bank, instead now you're going out to NAB or you're going out to CBA and you're still doing it under a trust. But I do think there is a point at which we will probably see the crackdown of trust lending and potentially that loop that they need to close off when it comes to going out and effectively having unlimited borrowing capacity. Now, another major thing that's played out in the banks is this 40-year loan term that some of the banks and lenders are now offering. So traditionally, if you go to a big four bank, you're going out there and getting a loan, it's a 30-year loan term, which means effectively, if you pay interest plus principal, you'd pay it off in 30 years' time. Now, what's being offered by some lenders is a 40-year loan term. And you might be thinking, why would I want to do a 40-year loan term when I could just do it in 30? Well, the key reason is now you've got an extra 10 years to be able to pay off that loan, which means effectively your repayments decrease and thereby actually increases your borrowing capacity. So it increases it by between 8 and 10%, which is absolutely absurd because on $1 million property, it could mean an extra $80,000 to $100,000 just by going, I'm not taking a 30-year loan term, I'm taking a 40-year loan term. Now, not every lender actually offers this, and this is why it's so important you get with the right brokers that know what's changing and how quickly it's changing. On the same day that you can have a bank go and increase their fixed rates, a different lender can go and decrease their variable rates and fixed rates. So to keep up with the market, to get the best deals, you're absolutely going to miss something. And for someone like myself who absolutely loves this stuff, and I'm in this 24/7, I still need the help of brokers to be able to go and do it. I'll leave a link in the description box below for you to go ahead and reach out to Refine Loans, who are the best in the business when it comes to scaling a portfolio. If you're interested in buying one property and it's your first home, probably don't contact them, because what they do is they specialize in saying, okay, your borrowing capacity is this, and you want to increase it. You want to go and buy a 10, 15, 20 property portfolio. I'm going to structure it the right way and get you what you need. So very sophisticated. And so I urge you, book in that free call. Now, another thing lenders are doing is this LMI waiver. So lender's mortgage insurance is typically paid on when you have a deposit less than 20%. So you'll often see that it takes, 6, 7 years now, and it takes so much longer to get into the property market with a 20% deposit. The fact that we're in 2025 and 2026 and people are still thinking we need a 20% deposit is absurd, because so many lenders now offer 5% deposits, 10% deposits, but you have to pay lender's mortgage insurance. Well, now there's a couple of lenders that have come out and they've said, actually, you don't need lender's mortgage insurance. You can come to us at a 90% lend and your interest rates are very comparable to many other lenders at 80%. And you know what? You're going to save on LMI, which could be up to $15,000 or $20,000. So the fact that that barrier to entry has now been removed, your deposit can be much lower. And if you get offered a 40-year loan term, you're starting to really cook. And why is this all important? Because it allows the availability of credit. I said a couple of years ago that when interest rates started moving up, I said, look, what they're doing is they're tightening the taps. So if you think about it, it's a tap, the water comes out. As there's more water, it's going to feed into this ocean and increase, which means all boats are lifted. And that means boats, in this case, would be house prices, and they continue rising. What happened during that period is we saw a tightening of that. We saw the same thing when APRA came in 2017, 2018, and prices went down. The same thing happened when interest rates started going up. People freaked out and the banks weren't lending as much, people weren't taking on as much, and we also had all these buffers and shading in place with interest rates moving up, so a lot of people couldn't actually buy. Now, during those times, you're going to see affordable properties absolutely take off, because someone who wanted to buy can't afford 800K but can afford 600K, which is why in 2020 I said on this channel, you want a recession-proof property portfolio. That's exactly what we've been building out for clients. I did it myself, I do it currently, and I still purchase property, with the latest one only settling a couple of weeks ago. If you need help with actually sourcing the right properties and having the right strategy, I'll leave a link in the description box below for a free call. You can figure out what the strategy looks like, what you're actually wanting to do long term. And it's a buyer's agency with 50 full-time staff, so there's not like 1 or 2 people just trying to make it work. We have a full-fledged team looking at data every single day, multiple areas, and we're buying across 5 different states. And we're specializing starting in between $500K and $900,000. So if you're one of those people that need to move in this market, you need the help, because we do go out and purchase with speed, but we can do that because we have data as well as really, really strong relationships and a robust system for our due diligence process. Now, there is a strong correlation, and you've seen it time and time again. If you look back at data, you look at graphs, you look at tables, and it'll tell you the one thing, which is as the money supply increases, which is M2, M3, it has a big correlation to asset prices, which is why you've seen since 2020, the world has completely changed. The amount of money printing, which is often the common term for quantitative easing, has come into the system. It's caused asset prices to absolutely go up, which is why so many people today are like, are we in a bubble? Are we in a bubble? We are definitely in a bubble, but not the bubble that you think. It is the bubble of the currency. It's an absolute Ponzi scheme. Most people now have realized how bad this system actually is. That's why you saw inflation go up and everything costing a lot more. It's a similar sort of feel that you had in 1970s when we came off the gold standard. Now, I don't want to make this a history lesson about currency, but back then what happened was you could go out to the bank and everything they had in their bank vault was backed by gold. But as soon as that was removed, it meant that asset prices went through the roof, because now it's not backed by anything. And then you got fractional reserve banking, which means effectively I can say I have this money and I'm going to owe you money and then I'll owe you money, but really I don't have all of that money. So if everyone came back to me and said, hey, there's going to be a bank run and they want my money, I don't have it. And that's effectively why you have such big cash controls where you can't go to the bank and say, hey, I want $50,000. Obviously, they're going to say it's for security purposes, but they don't want a bank run. And that's why since 2020, I was so confident that you needed to be in assets, because assets were absolutely going to balloon up. And are they worth so much more today versus say 10 years ago? No. But it's because the currency keeps going down and it's going to continue going down, which is why you need assets. We'll continue saying it, and there will still be people in the comments going, whoa, no, property's in a bubble, Bitcoin's a bubble, share markets are a bubble, ETFs are shit. Like, you've got to go out there, make that decision for yourself, have the right team, have the right strategy that you can follow, and you will do extremely well. I promise you. There's nothing else in the world that's going to build your wealth as fast if you aren't going out there and investing and taking on some sort of risk. I want to know what your thoughts are around what's happening in the lending space. Do you think we're headed towards another GFC situation, despite the fact that we do have responsible lending and some people think it's irresponsible? Let me know in the comments down below. And if you're interested in knowing how you can recycle debt, which is debt in your own home, to make it tax deductible to go and purchase more real estate and pay off your home even faster, go and check out this video. It will blow your mind if you've not heard about this concept before. I hope you guys have enjoyed this video. If you have, subscribe, and I'll catch you guys in the next one. Thanks, guys.